Hello, everyone. Welcome to today's lecture on financial engineering. And in our last class, I have started this chapter, and in which I covered zero coupon bonds as a tool of financial engineering, along with some starting discussion of mortgage-backed securities, in which we discussed the process of pass-through certificates and the potential risk associated with those pass-through certificates, investors of pass-through certificates, such as prepayment risks and reinvestment risks, kind of things. Or we also discussed uh, the zero coupon bonds and why the zeros are used by investment banks as a tool of financial engineering. Today, we're going to discuss the rest of the part of this chapter, and we will start with the upgraded version or the subsequent or a modified version of mortgage-backed securities. And we learned that in mortgage-backed securities allows the generators of the mortgages to remove the illiquid mortgage from its balance sheet and subsequently reuse the mortgage facilities to generate additional funds by backing those mortgage illiquid mortgage instruments. All right, let me share my screen first so that we can have a look at the contents of today's lecture. So as I discussed, as I mentioned, we're going to start with collateralized mortgage obligation, or it is known as CMO. I will refer CMO in subsequent in this lecture to refer these collateralized mortgage obligations. All right. So first of all, look at the paragraph here. What defines the concepts are the source or reasons why investment banks or other financial institutions use this CMO as an upgraded version of MBS. So it looks like an investment bank purchases mortgage pass-throughs or whole mortgage and then uses special bonds that are collateralized by the mortgages. The bonds are divided into series of distinct tranches. The cash flows maturity riskiness of each of the tranches are different. All right. First of all, before going through the interpretation of this statement, I would say that in case of mortgage-backed securities, you saw that the investors of the pass-through certificates have an identical pattern of risk, identical cash flows, identical instruments. In that case, all of the investors are exposed to similar kind of risks here. All right, but in case of collateralized mortgage or CMO, in that particular case, you can see the cash flows, maturities, riskiness of each of the tranches are different. All right. By tranches, we mean that the money, all right. So money of the bond. Okay. On the first part of this statement, you see an investment bank purchase mortgage pass-throughs here. So in usually that happens, the pass-throughs add considerable amount of liquidity in the mortgage markets, since it allows the mortgagee to remove that liquid mortgage from the balance sheet. All right. But pass-throughs are single asset based, and investors are entitled to same class of asset maturity, cash flows, and risks. Just to recap my statement or interpretation here. In that case, to address the prepayment risk and the associated risks that involved in MBS, in 1983, CMOs are introduced. Okay, as you have to learn some background history in that case, and since then, many variants of this CMO are evolved or used by investment bank as a tool of financial engineering. Okay, what happens in that case? The CMO is another example of conversion arbitrage, and what conversion arbitrage means. I interpreted this term in my last lecture, and in that case, the IB or investment banks purchase pass-throughs here, And the bonds are then divided into tranches with different cash flows. Because the cash flows are different, therefore it allows the single class mortgage-backed securities to be converted into multi-class CMOs. Okay, well, how is that? And it will be pretty much, yeah, there is a graph there, but it will be pretty easy for you to understand the concept if I share my whiteboard and give you a diagram regarding this. That will be pretty much easy, I guess. So in that case, what happens, the mortgager, as in our example previously, we know the mortgager are those who borrow. In that case, we see the mortgagers mortgage amounts are pooled by trust or mortgage bankers. That is pool that this pooling eventually generates pass-through certificates. By P, I refer pass-throughs, P1 pass-through 1, P2 pass-through 3, and these are the securities, pass-through securities. All right. Investment banks combine all these pass-throughs, as the definition, as the statement here elaborated. Investment banks combine these pass-throughs and issue new bonds in that case with different maturities in that circumstance, along with different cash flows. Okay, so different bonds are issued. Those are known as tranches, as you have seen here. These bonds are eventually referred to as tranches. By T, I refer to the tranches. So tranches, those tranches that have different maturities, different cash flow streams, and different level of risk as well, so that the investors can access to, or the investors can match their potential risk preference in that case. Okay, and the associated asset allocation. Okay, let me close this sharing so that I can move to our original slides. All right, so in that case, as I mentioned just a few minutes ago, in that case, each tranche receives proportionate interest payment. Okay, so listen carefully, because this part of the discussion discusses the most important part of the mechanisms of tranches, mechanisms of CM in particular, right? As you have seen in my whiteboard that I mentioned, that the investment banks combine those pass-through certificates of MBS or mortgage-backed securities and issue different classes of bonds that are represented, but that bonds are divided into series of distinct tranches. As you can see here, the cash flows, maturities, and riskiness are different. Okay. All right. What is the mechanism here? In that case, each tranche receives proportionate interest payment along with the proportionate interest payment. Okay, there is what are those interest payments? Because this pass-through, you know that these tranches are generated from the pass-throughs of MBS, and those pass-throughs continuously receives interest and principal, but all the tranches receive the interest payment. However, only one tranche gets the principal, and that one tranche that receives the principal initially is called the fastest pay tranche. Okay, so in that case, everyone receives the principal, but only one tranches that receive the principal amount. All right, all other tranches receives interest. I mean, every tranche receives interest, but only one tranche receives the principal amount, and that particular tranche is called the fastest pay tranche. Okay, it receives all principal until it is fully repaid. So this tranche gets all the principal until it is fully repaid. After that repayment in full of the until this repayment of the full of the first tranche, second tranche becomes the fastest pay tranches. Usually there are maybe you can say that more than 10 tranches or nothing less than 4 tranches. Okay. So in that case, as I said, subsequently that happens continuously. That happens once the tranches are repaid in full by means of principal payment, then subsequent tranches become the fastest pay tranches in which eventually receives the principal until unless the tranches are repaid in full. Okay, so this is these are the examples. This is the concept basically of how these tranches and collateralized mortgage obligations work here. Okay. So there are several types of collateralized mortgage obligations, then the generic CMOs, and then derivative mortgage CMOs. In generic CMOs, we have seen the plain vanilla CMO and zero coupon like CMO. And the concept that I have already discussed here is plain vanilla CMO. And later on, we'll discuss zero coupon like CMOs and planned amortization classes, target amortization classes, principal only and interest only CMOs. These concepts are very easy if you give a little bit more concentration, and then you will understand all of these issues very easily. As I said, there are tranches backed by the +2 certificates on that, and in that case, all the tranches receive the interest, but only one tranches at a time receives the principal. And once this principal is prepaid on that particular tranches, the second tranche becomes the fastest tranche, and these tranches are paid the principal. And if that after the repayment of the principal of the second tranches, the third tranches become the fastest pay principal, and that process goes down like this. All right. So as this is often called the plain vanilla CMO. Now, what happens in zero coupon like CMOs? All right. In zero coupon like CMOs, since zero coupon, as you know, that does not pay any interim coupons, the CMO that act like zero coupon tranches usually follows the investment pattern of accrual bonds. All right. In accrual bonds, just like zeros, create deferred interest obligation. As you know, what does deferred interest obligation mean? Just like zero coupon bonds, that since the coupons are not paid, it deferred interest obligations. It is kind of sometimes called deferred interest obligations because the payment of interest and accrued principals are paid at the end of the maturity. All right. In accrued bonds, accrual bonds, unless the other tranches are fully repaid, the accrual bonds do not get anything. এক্ষেত্রে যেটা হয় যে ইন্টারেস্ট যেটা পেতো সেটা অ্যাক্রু হতে থাকে, and the accrual bonds neither gets any interest nor the principal. All right. So unless the other tranches here are fully repaid, and CMOs reduces the prepayment risks. In that case, just let me get through the accreditation. Okay, the zero coupon like CMOs often called, as I referred to in my lecture, that it is sometimes called accrual bonds, it's accretion bonds, or Z bonds. Okay. So as you like in that as I mentioned here, the and zero coupon bonds, the interest is kind of interest deferral obligation bonds, and those payments are not paid to the zero coupon like CMOs unless the other payments are made. CMO reduces prepayment risks here. How is that? maturity, there is a mention of residuals, as I know, but okay, I will discuss this in later part anyway. How does CMOs in that case reduce prepayment risks? Maturity of tranches here generally shows ascending pattern, with first tranches have the shortest life. Okay, what happens in that case? Therefore, coupon accrued to the tranches have the similar pattern, with the short life tranches have short life tranche has the lowest coupon in that case, and such attributes consequently allow investors to choose investment option that matches his or her investment goals. Okay, what happens in that case? Therefore, investors are willing to pay more for CMO tranches than the mortgage-backed pass-throughs, because that is the reason for this is in mortgage-backed pass-throughs do not allow investors to have the luxury of these choices of maturity, separate choices of maturities, and separate choices of risk levels. Okay, since I said it follows an ascending order, the tranches with the first tranches one may have the shortest life, and then intermediate life in the middle tranches, and then the lower upper tranches have the longest life in that case. And these coupon payments of those tranches matches those maturities of associated matches those associated maturities. Okay, and in that case, you might have asked a question that why should investment banks deal with these securities or instruments in that circumstances? Similarly, similar to mortgage-backed securities, the value of CMO tranches is greater than that of pass-throughs, and IBs or investment banks in that case get profit from spread. Okay, so just like other cases, as I said, the collateralized mortgage obligation tranches usually have a higher value compared to the mortgage-backed securities or pass-through securities in that case. And investment banks generally receives a spread of the investment of pass-throughs and the return that it usually gets from the issuance of the CMOs or particular CMOs tranches. Okay, so this difference between these two rates generates a spread, and which is the source of profit for the investment banks. Secondly, investment banks act as market makers to create secondary market for the CMOs. Okay, this is one of the sources, and in that circumstance, as you know, that because of the market maker of the CMOs, investment banks can get profit from the bid-ask spread of the transactions in that particular instrument. Okay, so firstly, the for first benefit for the investment banks is the profit from the spread between the CMO tranches and the pass-through certificates, and a return difference between CMO tranches and the pass-through certificates. And secondly, the investment bank work as an market maker for these particular securities to be effective in the secondary market. Okay. I was mentioning about the accrual bonds in that case under the zero coupon like CMOs. Okay, the accrual bonds generally create residuals. How does this residual make sense in that case? Accrual bonds create residuals, and when reinvestment rate, when this residual is created, when the reinvestment rate of funds received by trust is more than the rate of accrual bonds in more than the rate that the accrual bonds usually get in that case. All right, specifically, in other words, what I mean here is that when the trust or who pools the mortgage-backed securities. Okay, if the reinvestment rate of the fund pooled by the trust in that case is greater than the rate that is accrued to the zero coupon like CMOs, then there is a residual. There is a positive residual. Okay, more specifically, there is a positive residual. When the positive residual is created, when the reinvestment rate of the trust for the fund pooled by the guarantor or trust in that case is greater than the rate that is accrued to the zero coupon like CMOs, then there is a positive residual. And this positive residual becomes negative when other situation is created, like when the reinvestment rate is lower than the rate that is accrued to the zero coupon like CMOs. Okay, so in that to deal with, however, the residuals is uncertain at the beginning of the time, and the issuer often sells it to the investors who are willing to take it. In that case, the trust of the issuer or the pass-throughs often wants to get rid of this residual claim because the residuals because of the uncertainty associated with the reinvestment rates. All right. So here they can get rid of these residuals and sell it to the investors, those who are willing to take it. Excuse me for the disturbance. Okay, I had to attend the call. Anyway, as I said, I was discussing about the residual part of the zero coupon like CMOs, and how, when and how the residuals are created, and what are the consequences, and what are the ways and why investment banks sometimes, or the issuer sometimes, sell the residuals to the potential investors. Okay, just to reduce the uncertainty associated with the residuals. And how in that case, okay, so here is the structure of CMOs. If you understand my discussion related to previous slides, you understand the graph or diagram here. The interest and principal the master servicer receives, and they are transferred to the subsequent tranches. And the second tranches here is the fastest paid tranches, because the first tranche is already been repaid, and all of the tranches receive the interest, but only at time only one tranche is received the principal, and the similar things happen here. All right. Okay, collateralized mortgage obligations are the benefits of investment banks that I have already discussed here. And issuance procedure of CMO or CMO in that case is similar to the IPO or the issuance of securities as other securities. All right, in that case, the filing requires Securities and Exchange Commission approval, and the expenses for other procedures such as due diligence process. Okay. However, the issuer sometimes reduce these kind of hassles in terms of securities, in terms of regulators' approval and expenses by means of self-registration. And you know the concept of self-registration. All right, so the self-registration reduces this kind of hassles and procedural obligations. So sometimes the issuers follow the self-registration rules. And how the developments of CMOs, and or how can CMO are how the CMOs are created in that case. Financial institutions or investment banks can, there are several ways, but I will discuss two very important ways. First, and developments of CMOs here. The first one is that the financial institutions or investment banks can buy whole mortgage-backed securities and use them to generate CMO. Okay, so they can take the whole mortgage-backed securities and combine them and pool them, and then generate the CMO. Secondly, the mortgage originators can generate their own CMO instead of the investment banks purchase those mortgage-based securities and create separate CMO. In that case, mortgage originators can generate their own CMO, and investment banks in that particular case plays the role of underwriter. Okay, those who cannot take the advantage of efficiency can sell their small mortgages to another institutions who can take the advantage of volume and market, and take the advantage of economies of scale as well. So what happens here is that sometimes the some of the mortgagee, those who are pretty small, cannot take the advantage of this securitization process. What happens in that case? They can sell their mortgages or the pool of mortgages to other institutions, those who have a very good market and those who have a very large volume of mortgage pools, and take the advantage of economies of scale. And this taking advantage of economies of scale can reduce the overall cost of CMOs or securitization. So to summarize point 3, developments of CMOs, here I discussed 2 ways particularly. In one way, the investment banks can take the whole MBS and create their own CMO. In the second way, the mortgage originators or mortgagee can generate or pool the mortgage and use those pool of mortgages to generate their own CMO. And investment banks in that case helps the mortgage originators in the form of underwriter. All right, so they underwrite, they facilitate the full procedures in that case and help the mortgage originators to prepare their self CMOs here. All right, so as I was discussing here, generic CMOs, plain vanilla and zero coupon, I discussed. Derivative mortgage CMOs, I will discuss now. The mortgage derivative CMOs, there are 3 planned amortization classes, or shortly known as PACs, target amortization classes, tax and a principal only and interest only. Different forms of CMOs are evolved, which is known as derivative mortgage products. All right, what are those? Because it involves this derivative mortgage CMOs basically has different risk pattern, and it sometimes reduces the investor's overall risks, or sometimes intends to reduce the investors of those CMOs a risk level to a minimal, or reduce the risk level to an acceptable form. All right. First one is planned amortization classes. In that case, listen carefully. In that case, the holder gets a granted amortized similar to sinking fund process of bonds. All right. So in the sinking fund amortization of bonds, you know that the fixed amount of principals are amortized periodically with the use of sinking fund. Same thing happens here, but not with the use of sinking fund. But in that case, the holder gets the guaranteed amortization of principals. Okay, here PAC, I will refer PAC to denote the principal amortization classes. In that case, PAC receives a guaranteed payment as long as the prepayment rate stays in a certain band. What I mean here, if you are not clear what I mean here, this prepayment rate, what I mean by prepayment rate, because as you know that the mortgager or originator of the mortgage may have the chance to prepay the mortgages or prepay the amount for the tranches. But this prepayment, if this prepayment rate sometimes varies, okay, so at the beginning this the issuer sets a band for this prepayment. All right, within this in excess of or outside this band, this prepayment is not acceptable. So the issuer In that case, the issuer of the planned amortization classes in that case ensures this prepayment band. And if the prepayment is within this band, then it is more likely that the investors of the PAC receives a guaranteed payment. All right. PAC reduces the cash flow fluctuations because, as you know, that because of this prepayment, since the prepayment is within this band, so there the cash flow fluctuations in their circumstance are reduced. All right. PAC investors in that case accept lower yield since the risk of prepayment is low and cash flows is more or less stable or certain. Okay. Here, other tranches assume higher uncertainty to accommodate higher certainty of PAC. Okay, the PAC has claimed precedence relative to other tranches in that case, and the other tranches in that case are known as support tranches or companion bonds. The yield of companion bond is therefore higher because of the facilities that they sacrifice in favor of PAC. Okay, so as I mean here that the other companion bonds in that case sacrifice because big sacrifice and sacrifice in the sense that they are giving the PACs the room for certainty, and their certainty comes at the expense of the uncertainty associated with other support tranches in that case. And because of the uncertainty associated with that, the yield or the return of the support tranches or the companion bonds are higher in that case. Okay, so this is what is called planned amortization classes. Then comes targeted amortization class or TAC. In that case, what happened? These particular CMO tranches receive a specific monthly principal. Okay, similar to planned amortization class. In that case, the TAC investors receive tranches receive specific monthly principal, and if the principal is less than the expected principal, if the actual principal is less than expected principal, then the maturity of tranches goes up, because sometimes that happens that the payment of principal is low because of the default risks or because of the default or bankruptcy of the mortgager, because of the mortgager. In that case, if the mortgager fails to pay the principal, or in that case the actual principal is less than expected, if the actual principal is less than expected, then the maturity of the tranches in that case will go up because they are not yet paid. Okay, and it will take more time to repay the principal. Okay, if the actual principal is greater than expected, then the excess of this principal payment is passed through the other non-TAC tranches. All right. So if excess principal, because since the principal received by TAC investor is specified at the beginning, so in excess principal payments will be transferred to the non-TAC tranches. Okay, this is the concept of target amortization class, and the concept of TAC and PAC is more or less the same. And in either cases, the investors receive the guaranteed or specific amount of principals. Okay, but there are some minor differences, and you refer to the lecture, you refer to my lecture to find out those minor differences and go through the text as well. The third one is principal only and interest only principal. In that case, the issuer of CMOs in that case separate the obligations in terms of principal only and interest only. In interest only, a case some of the claims are some of the securities are created to separate the principal component and interest component of the mortgage. The claims are sometimes transferred to interest payments of the interest payment of the CMO. Sometimes are referred to the interest only investors, and the principal payments are sometimes transferred to the principal only tranches investor. Okay, so when the interest rates are low, then prepayment is more likely, as you know that because of the lower the interest rate, then the it is more likely the prepayment of the loan is more evident. Okay, and if this prepayment is if this prepayment occurs because of the lower interest rates or the interest rate decline, then it is transferred to the principal only franchise investors. Okay, so in that case, the principal only investors, thus in that case, payments to IO means interest only is lower than PO. Okay, so if the interest rate, to summarize, if the interest rate is low, the prepayment is high, and since the prepayment is high, this payment of principal, or the prepayment of the principal, is transferred to principal only investors, those who are taking the position of POCMOs. Okay, so similar things happen, opposite happens when the interest rate is high. And that case, the bearish the market is bearish, then the return of interest on the investors will be higher. Okay, in that case. All right. To add another thing in that case, as I was referring to, the interest, lower the interest rate, the prepayment is high. In that case, payment to the interest only investors is lower than the payment to the principal only investors because of the declining interest rate. And since the prepayment is occurred in that case, the prepayment to the principal, or the payment to the principal only investors, is higher in that case. How does CMO reduce prepayment risks? All right, it does so by creating multi-class instrument. In turn, if you this slide, particular slide, summarizes all the discussion. If you can link the discussion with this slide, that would be a very that will be very easy for you to understand this overall concept of CMO and prepayment risk management. It does so by creating multi-class instrument, as I was saying, that the creation of separate tranches with separate risk maturities and risks here, in turn allows investors to choose a tranche which best reflects the investor's risk preference. All right, so if you are pretty much risk averse investors, you go for the tranche 1, which has lower maturity and lower coupon rate. Okay, and subsequently, if you're risk levered, then, or if you're less risk averse, then you can move on to the subsequent tranches that has higher maturity and higher coupon payments. The structure of CMO means that the first tranche will have shorter life than the second tranches, and the second tranche will have a shorter life than the third tranches. So a higher risk averse, that I was discussing here, the higher risk averse investors will purchase the first tranches, and then consequently will be willing to take lower yield, and the moderate risk taker will purchase the second tranches, and so on. So these are the cases because you are adjusting your risks along with your payments of the payments of the tranches, so you can eradicate or reduce the prepayment risk here because you are taking positions of separate versions of tranches. Okay, then there was another discussion that I was that was skipped here, which is value embedded option. Before discussing the asset-backed securities, I would like to discuss the value embedded option in that case, value of the embedded option, because you know that mortgager has the option to prepay their payment prior to maturity, and these in turn creates embedded call option or embedded option to the mortgager. As I was discussing in my last class, what happens in that case, the mortgagee is compensated in the form of higher yield because the mortgagee is providing the mortgager with the option to prepay their fund prior to maturity, and such option creates such option is provided by the mortgagee, and hence the mortgagee should be compensated for this. And this compensation comes in the form of higher yield or higher cost by the mortgager to mortgagee. Okay, so these higher cost or these yields are adjusted in several ways by the mortgagee. In one form, they create or calculate the option adjusted spread. Another way of dealing with this embedded option that the issuer often a second way to adjust this in adjust this embedded option is to create the or to develop or to calculate the duration, and then you know that the concept of duration here it measures the interest rate risk as well. So there are two options, there are two adjustments to there are two options or two adjustments that should be taken into consideration to adjust or to justify the value of the embedded option. One is to prepare or calculate the option adjusted spread. Another one is to measure the option adjusted duration. Okay. So finally, what comes here is the asset-backed securities, and this is a very broader version of mortgage-backed securities, okay, or any other pass-through certificates that I was discussing. The CMOs were produced using mortgages and pass-throughs, treasury-based zeros. That was the discussion of my last lecture. Treasury-based zeros are produced using conventional treasury bonds, as you know. Similarly, any other revenue-generating assets can be used as derivative product. All right. So in today's lecture, we have used the pass-through certificates to generate CMOs. In my last lecture, we have discussed the creation of zeros from conventional treasury bonds and the creation of pass-through certificates from mortgages. Okay. So any cash flows from any assets other than real estate, such real estates will create asset-backed securities. All right. So any cash flows from credit card, any cash flows from automobile loans or personal assets such as computer, student loan, aircraft leases, any cash flows, the cash flows may be from these instruments back the debt issuance, then it is called asset-backed securities. If you understand the concept of mortgage-backed securities, then you can relate the definition of asset-backed securities here, or the concept of ABS here. Because, for example, if the credit card loans by the banks may involve the payments, periodic payments of interest and principals, and along with other servicing fees, or the payoff from the automobile loans on the other computers or other personal assets and student loans or aircraft leases, the payments, if these payoffs from these kind of obligations create the basis for the debt issuance, then it is called asset-backed securities, or in other words, the broader term, it is called securitization process. Okay, so the risk associated with this ABS are similar to other MBS or CMOs, and the benefits from the investment banks are same. All right, in that case, the benefits from the investment banks comes in the form of underwriting, comes in the form of market making, in the form of broker and dealership of this ABS, and the risks associated with these ABS, such as prepayment risks and reinvestment risks, are still there in case of ABS as well. Okay, so this is the coverage of full chapter, and if the asset-backed securities, ABS discussion of ABS is not that much of lengthy, because this version of asset-backed securities comes from the overall discussion of previous two classes, including today's class. Okay, so if you understand all of these MBS things or CMOs, then you can understand the asset-backed securities. So any cash flows from any assets that back the debt issuances can be treated as the asset-backed securities. All right, ranging from credit card securitizations to aircraft lease asset-backed securities, to name a few here. Okay, so that basically concludes our financial engineering chapter. All right, so please go through the lecture videos If you can't understand anything, go frequently of these terms here and go through the text, and then you will understand the full concept of this discussion. All right. So thank you very much.